Thanks very much, John. Good afternoon, everybody. It's always a little bit intimidating to be the crescendo talk somewhere. I'd rather the expectations are low, you know, maybe average or a little better, but hang around. So you can see my frame of mind yesterday. At Douglas-Westwood, we always have two rules. On every page, you have to have a graph and a picture. So we spent a lot of time on pictures. This is my state of mind yesterday, so you can tell whether I'm feeling optimistic or pessimistic about the oil business based upon this. So, a little bit about us. Douglas-Westwood is an oil field services consultancy. We count widgets for the companies that provide services to the likes of Shale and BP and Total. Our clients, our corporate clients, are the likes of GE Oil and Gas, FMC Technologies, Baker Hughes, Schlumberger, and that said, we have offices in New York, which is of course the most important one because of its position in the oil center, but we also have offices in Canterbury, in Houston, and Singapore. For our clients, we provide market studies and commercial due diligence. Today in New York, we have two projects. We're assisting a private equity fund in an acquisition in the several $100 million range, and we are doing the energy sector strategy for a corporate Fortune 500 company. So that's the sort of things we do. I run our New York office. I'm going to go through our sort of standard oil and gas outlook, and I just start with a comment on what's a little bit different from the way that I came to this business from what most of the people here and most people in the industry have. If you take a look at the typical presentations in this industry, and this is true for the analysts as well as for many of the people here, they tend to be quite supply side oriented. So we'll hear a lot about decline rates and the reserves and so forth. My work is focused more on the demand side accommodation issues. So today we'll be talking a little bit, really more about how society adjusts and what's happened in the last few years. All right, so the oil supply in historical context. I've highlighted for you here three periods in the oil supply since 1960. From the period 1960 to 1972, the oil supply increased by 150%, from 20 to about 50 million barrels per day. It increased at the pace of 2.7 million barrels per day per year during this period. And this period oversaw the motorization of the West, which was about 1.2 billion people, and it took about 12 years to do that. In the second oil shock, highlighted here in green, because I guess green is a good number for oil shocks, what happened was that, of course, there was the Iran-Iraq War, and then the high prices at OPEC pegged thereafter. But the response was quite quick. By 1983, so just 4 years later, the world had 25% spare production capacity. This meant that production capacity had grown 7 million barrels per day during that period, primarily in the Gulf of Mexico and North Sea. And global oil consumption had dropped by 6 million barrels per day. This period then essentially meant that we had a long period of overcapacity that was to plague the industry really up until the early 2000s. And today when we talk about the crisis of personnel and of assets in the industry, it is this period, this second oil shock, which took a generation to absorb and meant that the industry didn't invest in people or in assets during that time. The third oil shock, I mean, you could count more shocks here if you wanted to, but essentially the third period here starts in 2005 with the stalling of the oil supply. And again, we have the same sorts of demand pressures we had in 1960. We have 1.3 billion people, plus or minus, depending upon how we want to deal with some of the emerging markets. And during this time, crude oil production capacity increased by 350,000 barrels per day over a 7-year period. And oil consumption from other petroleum liquids as well increased by 3.1 million barrels per day. So unlike 1979, when there had been a rapid response to high oil prices with a drop in demand and a rapid increase in production capacity, we saw just the opposite now. And that's the world we inhabit today. Plenty of demand, not too much supply. In fact, if we go back to 2004, we might have anticipated, had CIRA's forecast, who's it that was taking on CIRA? CIRA's mistake when they forecast in 2005 for, I think it was 100 million barrels of production in 2010 or 11. The way they forecast that was on a demand-based forecast, because if you just went up, you figured, well, about that time, that's how many barrels you would need. And in fact, if you look at the yellow line, that's just about how much demand there should have been. But what didn't occur at that time was the supply didn't grow. So you had 30% global GDP growth from 2004 to 2011, and you had all of 2% oil supply growth. And that's essentially where we are. Today, we are already missing the equivalent of a Saudi Arabia and an Iraq compared to where we were in 2004. And this is where Shale was talking about, oh, we've already knocked off a North Sea. It's the same sort of idea here. If we look at the liquid supply from 2010 to 2012, total production was up 1.9 million barrels a day on nearly 90 million barrels a day of production. In 2 years, since we have to adjust for the Arab Spring that occurred last year, it gives us bad data, but in 2 years it's up about 2%, so growing by about 1% a year. Of this growth, the US and Canada provided the lion's share. Our calculation for how much oil we need to supply everybody's needs so they can grow at what would be the traditional paces given the state of development for the global economy is about 2.4 million barrels per day. So we're barely able to cover about half of what we need to increase, to keep up with global GDP growth. If we look out at the liquid supply until 2016, this is from my friend Jason Stevens of Morningstar, also a regular here at ASPO conferences, not with us today. Conventional production is expected largely flat, about 4 million barrels of liquids growth overall from deepwater oil sands and unconventional. And so that's again about 1 million barrels per day per year, quite low number as we look out forward here. Okay, so if we have lots of demand, primarily from China and the other emerging economies, and we have a limited supply of oil growth, how then will this supply of oil be allocated? What we've seen since the beginning of the Great Recession, that's from December 2007, the emerging market demand has increased by about 7 million barrels per day, and the OECD economies have reduced their consumption by about 4 million barrels per day. Thus, OECD consumers are providing about 56% of non-OECD oil consumption growth. Okay? If you take a look here for the small one, this is how we separate out the people over 50 from under 50. The people under 50 can read those two little boxes on the right. We have this huge thing at Douglas-Westwood because we have these very young analysts who are always gung-ho and they keep reducing the font size. So I had a little rebellion there last week. I was like, no, I can't do it. All right. If we look at the countries in financial crisis, they are pretty much without exception donor countries here. They're the ones that are linked to the blue line. Okay? The ones who have given up consumption include the US, UK, Ireland, Iceland, Greece, Spain, Portugal, Hungary, Italy, France, Cyprus, Estonia, Latvia, Lithuania, Netherlands, Japan, a number of others. The financial crisis has been concentrated in these countries. And that's very counterintuitive. Michael Kumhof's here from the IMF, and if you went to the IMF and you asked them, I have a country in a financial crisis. Is it an OECD country or a non-OECD country? If I had posed that question before 2005, Michael would have, without hesitation, said, oh, that's an emerging economy, because that's where these crises used to happen. Not this time around. This time around, the non-OECD countries are essentially spared this financial crisis. And guess what? They're the ones who are increasing their oil consumption. So what does price then have to do? We do have a price forecast, but we can ask, what does the price have to do? What the price has to do today is it must reallocate consumption from OECD consumers to non-OECD consumers. Ergo, the oil price must be above what we call the carrying capacity, the maximum limit of the OECD, the advanced economies, and it must be below the carrying capacity of the non-OECD emerging economies. And in fact, that's what we see. In this world, the US is being squeezed out of oil imports, and that leads to energy independence. We simply are not. Well, that's what it, you know, I made this, forgive me if I repeat a joke here. I presented for Charles Hull up in Vermont about a month ago. And the comment that goes with this is that energy independence is like sexual abstinence. It's all very virtuous, but not a lot of fun. So that's where we are right now. We're just being squeezed out, and this is the process by which we're being squeezed out. So you have a supply response and you have a demand response, and that's very straightforward economics. There's nothing special about that. If we kind of look at this on a sort of country global basis, we can see this in action. You can see that US oil consumption for this cycle peaked in August of 2010, only a few months after the end of the recession, and we had already peaked in our oil consumption growth for this. And by the middle of last year, US oil consumption was falling year over year and has continued to fall year over year since then. It's falling at about a 1.6% per annum base right now. If you look at China, you can see that China was doing okay, also declining its rate of growth, but it hit that $125 Brent during the Arab Spring, and its demand growth collapsed, and it has begun to recover now when Brent went down to 110, okay? So you have the global supply in the gray in the middle. The Chinese growth will be above it. The US growth will be below it, okay? You can calculate the maximum carrying capacity. Today for the US, I would say it's about $95. So if Brent remains above 95, US oil consumption will continue to decline. And this is true for Europe more broadly. It's not just the US, but I tend to use US and China because it's sort of nice. But China's maximum carrying capacity is thought to be by the likes of Merrill Lynch and by Paul Sankey over at Deutsche Bank, be around 130. I don't think it's that high. You can see at 125, the Chinese pretty much choked on demand. So I think it's probably in the 115 to 120 range. So when you're above these prices, oil consumption will actually begin to fall in these countries. And that's a very important concept in thinking about how we're going to adjust to a world of finite oil supplies. We can look at this more specifically for the US. Our normal consumption growth for oil is 1.8% per annum. We broke trend in 2005 on what I might call the DeFeus date, which is pretty much the date that Ken DeFeus said that the oil supply reached half point and we'd stall out, and it's pretty much that date. And it's from that date that I dated my forecast back in 2007. And if you looked at that and tried to allocate back the demand into a fixed supply, you would find that US consumption would fall by about 1.5% per year. And that's exactly pretty much what it's done and what I anticipate it will continue to do. Okay? And you can see here that there are two cycles. There was the 2007 cycle with the recession, but you can see there was a second oil cycle, almost a small oil shock, in April of last year. So you can see we've already cycled twice since the beginning of the Great Recession. Okay? We are, just by way of background, we're about we're 16% off of trend for oil consumption here. So it should be about 22 million, we're at 18 and change. I would point out here to Shale's comments, if we talk about the US being addicted to oil, we have broken that addiction. But like many periods of withdrawal, it's highly unpleasant. So we are now on that trend down line, but that's not a nice place to be, really. It's better to be addicted, frankly. All right. So let's look at the longer term outlook, and this is for China. I'm told my analyst I've got a Hungarian and a Chinese analyst who work for me. My Hungarian one says they use this at MOL, which is Hungary's oil company. So I'm famous in Hungary, not only because I lived there, but in any event. So if you take a look at China, China's important in a lot of ways. It's very important for those of you who have problems with the IEA or with the EIA, or frankly for Shell or BP and Exxon. Because the way they balance their models is not on the oil supply side, as we'll see in a little bit. The way they balance the models is by assuming that the emerging markets do not emerge. Okay, that's very important. And the reason they assume that is because if they don't assume that, then they have to explain something to somebody. So if the EIA goes into, I have friends who run committees for Congress, on the E&P subcommittee, I'm friends with folks there. And if the EIA says, well, the US is going to be in secular decline of 1.5% per year for the oil supply, right, for its oil consumption, that's the sort of thing that some congressman on that committee might get a little bent out of shape and then haul in the EIA to explain that forecast. And these guys are not, bureaucrats by their nature do not want to be visible. It's just not their job, okay? They don't want to be lightning rods. And so consequently, when they are under pressure, they will tend to find someone who has no constituency, like China or India, and take away their oil consumption. Because there's nothing the Chinese can do to haul them into a congressional committee, okay? This is a function, and I don't mean this badly because I know these guys and I'm friends with many of these guys, but it's the nature of bureaucracies that they are not heroic by nature. It's not what they're paid to do, okay? All right, so for China, but if you take a look at China and you assume China would develop as would South Korea or Japan, and why not? If you take a look, countries' consumption actually develops in a quite uniform pattern. And that pattern is from the time the first guy on the block gets his car till the time the last guy on the block gets his car is 20 years. It's one generation. It's not 50 years, it's not 70 years, it's 20 years. okay? China got on that S-curve in about 2005. Therefore, if they develop like Korea or Japan, they would be finished materially and get to stable per capita oil consumption by around 2030. It's a quick process. It's not a slow process. It's important to understand that. If you want to take a look at the distinction between Korea and Japan, you'll notice that the slope where it goes up is almost exactly the same. But look at what's in between them. What's that flat part there in the red circle? That's the second oil shock. That's the 79 oil shock you're looking at, which for 6 years kept Korea flat, okay? But demand didn't disappear in Korea. It was postponed, that's all, okay? So as soon as the oil supply became available again, the Koreans within a very short period of time came back to their original trajectory and very quickly increased their demand. Okay, that's the pattern we should be expecting to see with China. If it's there, the Chinese will take it. Okay, they won't be fundamentally different from anyone else. And people say, oh, can you compare Japan and Korea and China? Sure you can. Who has the bigger population density? Korea, 3 times the population density of China. Japan, it's all mountains and an island. There's no place to drive. Okay, China has lots of places to drive. So we shouldn't anticipate that China is simply going to roll up and disappear. It's not. It's going to develop like Korea developed or Japan developed. That should be our default notion, okay? If it goes that way, China's demand is enormous. It could easily get 2.5 times US demand, and it could do it quite quickly. If you run a pro forma, China will add a US worth of oil consumption in the 7 years from 2018 to 2025. And people will say, oh, China couldn't possibly add a US worth of consumption in 7 years. In coal, China added a US consumption in 5 years to 2007. And then it added another US worth of consumption in the 5 years to 2012. Darn tootin' China can add a US worth of oil consumption in 7 years. Don't kid yourself, okay? China is normally half of incremental demand. So if China could put another 30, 40 million barrels on, then you can take that and double it once again. And you could find on paper as much as 80 million more barrels of demand out to 2030. We're not going to get there. Whether it's 140 or 120 or 150 demand, it's almost irrelevant because the oil supply is not going to get there. But we need to understand that lurking behind everything, when we say efficiency and all these sorts of things, is a China that is a very large country compared to the United States. And it will take oil in big quantities if it's available. Here are the forecasts. Just a supply forecast. Pro forma, one of our clients asked us to do this. Yeah, Shale, you're on here. You're the bottom number, and I'll do this here. But essentially, these forecasts from the top down, Exxon, EIA, and BP are all in the 103 to 107 range. This is a million barrels per day for 2030. IEA and Total are in the mid-90s, and then UPSA, which is Kel over there, this is ex-Shales. It was around 79. This is his 2008 work. And this is 75. And this just gives you a range of where the feelings are for where 2030 oil production might be today. It's very important to note all of these are peak oil forecasts. They're just how bad it is. Okay? None of them are able to keep up with demand by a large margin. How do we do our price outlook? So this is our pricing model that's evolved over time. Some of this data comes from Barclays, who has supported us very generously with both data and input in recent times. If you take a look, you can calculate out the carrying capacity of an economy for oil. So you can determine fairly easily what the price is where a given economy will start to reject oil consumption. Okay? That's the carrying capacity, that fulcrum point where if you raise the price beyond that, oil consumption will actually begin to decline. What you can see is that on the left side, the blue line is the United States, and the carrying capacity of the US for oil prices was quite a bit higher than that of either China, the red line, or the oil company approval price for projects back in 2003. Okay? So what that says, at those prices in 2003, the US consumer would have willingly paid much more to maintain that oil consumption than they had to in 2003. That's a normal situation. That's called the consumer surplus. Okay? As it went on, however, the oil companies kept increasing that approval price as the oil price went up. Right? And at a point in 2008, in fact, China's carrying capacity crosses over with the US. And at that point, China becomes the price maker in the markets. And the US is no longer the price maker. Okay? And then you can see the oil price continues to go up. And the interesting thing is in 2011, the oil company approval price So the price that oil companies would say yes to a project at is greater than the carrying capacity of the OECD economies. So the oil companies in 2011 were willing to approve projects at prices that European and American consumers could not afford to pay. That's a very unusual and not a very healthy place to be. In essence, where they were going was that they were allowing it to go up because the Chinese were still willing to pay more. Okay? Let me see if I can. What's very important in the carrying capacity, so while the yellow line is well below the carrying capacity of the countries, the oil price can grow much faster than the global carrying capacity, which is itself a function of global GDP growth, increase in oil efficiency usage, and dollar inflation, just to give you the cookbook for it, okay? So from 2003 until 2007, 2008, oil prices were able to grow much faster than the pace of global GDP growth because there was that consumer surplus underneath it. People were actually willing to pay more for that oil than they had to during that period. Okay. Since 2011, we are now in a position where the oil price threshold, the oil prices are literally at the limits of the global economy. Okay. At current oil prices, neither the OECD nor the US can maintain oil consumption at these levels. Okay. So we have now reached a point where the only way you can increase your oil price, leaving aside a shock, a supply shock, and some inelasticity questions, but in a gradual way over time, the only way you can do it is by increasing the global carrying capacity. That is, it can go up with GDP growth, dollar inflation, and increased efficiency in oil usage. Okay? Which means from here on out, your ability to raise oil prices is going to be much less than it was in the 5 or 6 years up to 2007, 2008. We're on a much more shallow trajectory, and that will be important as we go forward. Okay, so here's what the numbers actually are. In 2011, upstream spend, this is just things that count as CapEx from an oil company's point of view, was $444 billion, and then up 11% this past year to $614. These are Barclays numbers from their semi-annual survey. And then on the right hand is Sierra's Upstream Capital Cost Index, and you can see that that's risen quite a bit in the last few years, up more than 12%, I think, the last year, primarily on materials, energy, and labor. So one of our latest projects, so this is the latest wrinkle in the whole thinking about the development of the oil supply, is that we wanted to see whether our sector forecasts for upstream spend would actually fit into the global carrying capacity. What Douglas-Westwood does is we do forecasts for lots of different companies. So, for example, a company like FMC may come to us and say, how many subsea trees will be needed for production globally in a given year? Okay? So we do all the forecasts. You see these huge numbers going forward, and you go, wow, that's a pretty big number. And you know, can that actually be sustained? Does it actually fit the budget that the global economy can carry? So we did these budgets individually by sector: GTL, LNG, unconventional, onshore, offshore, whatever you want, gas, oil, the whole thing. So we essentially took Barclays numbers, which they have company by company for some 330 companies, and we projected that out by type of fuel or by type of hydrocarbon, okay? But we did it all the segments separately. Now when we added all these up, where we came out was that in fact our forecasts all fit within the global carrying capacity for price increases for oil. If our forecasts were higher than the yellow line, okay, then you'd have CapEx compression. In that case, you know, everybody would like to do these projects, but the global oil price simply won't sustain it. If it's below that, you have room for CapEx expansion, where the global consumer is willing to pay a little more and carry more in CapEx. It comes out about even the way we do this. However, there are two things that this analysis does not tell us because they're non-trivial analyses. One of them is that we do not look at cost increases in this. So this is just saying this is how much these budgets could increase nominally. We have not even attempted to answer the question, how much oil will this buy us? Okay? And there are two sides to that. One is just cost increases from technology, and the other is productivity increases from changes from geology. Okay? We haven't even looked at that, and Shale or Charles, and maybe Charles in Montana will take some time to do this for us. All I thought I'd talk a little bit about Petrobras. I've been negative on Petrobras for years, and I got some real big fans because I slammed Petrobras and everybody was still worshiping them. But here's a note from Credit Suisse on Petrobras. It's called The Sum of All Fears. It's an October 28th investment note. And what's happening in Petrobras is in that they had 3% quarter-on-quarter decline in production, an implicit 11% natural decline rate, 17% quarter-on-quarter underlying lifting cost increases, 11% including wages, and high exploration expenses. Okay. So if we go back to this previous slide and just take the case of Petrobras, then what we can see is Petrobras in this area is deteriorating quite rapidly and quite significantly. Okay, they're well off the pace. So both their productivity and their costs are well out of control. The question is, how much can we extrapolate? Is Petrobras purely a Brazilian creature, or is the challenges that Petrobras are facing something that can be generalized more broadly to the industry? Okay. The very important point of all this is that Petrobras is literally the great hope of offshore oil production, right? And they're just blowing their numbers absolutely left and right. And they're not able to hold production right now, right? Down 3% in a quarter. That's a pretty impressive decline rate. So these are all sorts of things that come in here and all issues that then come back and say, well, how much oil can this CapEx actually buy for us? Okay. Oil is one question. The underlying question, though, that most of us deal with here at ASPO, the thing that motivates us is really what is the effect of changes in the oil supply on the global economy, right? If the oil supply declines and no one cares, well, so what, right? But if the oil supply declines, then that affects economic activity, and then that's a big problem. In this one, I attempted to take a look at oil supply and mobility. So Shale has alluded to it, but what is unique about oil compared to any other commodity, including coal and gas, is that only oil is used for transportation. When we talk about being addicted to oil, what we mean by that is oil is not better than the substitutes. We mean oil is much better than the substitutes. It is virtually a miracle fluid if you spend a little time with it. Okay? It's the penicillin of energy. And because of that, we hypothesize, or I hypothesize, and Shell probably as well, that the transmission mechanism from the problems of oil into the economy must be through mobility, because that's where it's a monopoly fuel, essentially. Not in power, okay, and not even in plastic goods or anything like that. So we think mobility that's the hypothesis. So the question then is, well, how has mobility and oil consumption varied in the US since 1970? What we can see is that there was a very rapid increase in oil consumption and relatively smaller increase in mobility, back up to the first oil shock. The red one is the first oil shock. We see a drop in consumption and an increase in mobility, moderately, then a quick recovery in consumption, and then the second oil shock, the purple line, coming down. Now that is 2 recessions and 1 recovery. But from an oil perspective, it's 1 recession, all the way from 1981 to, from 1979 to 1983, okay? There is no break in the trend line, although in the middle of it, technically, you had a year of 3% growth. And then the next period, suddenly at the bottom of this, right, that's when the Saudis throw in the towel. We now have 13 million barrels per day of excess production capacity on 54 million barrels of consumption. 25% excess capacity right at the bottom there, at the bottom of the purple line. And from there up until 2005, with the exception of the '91 Gulf War, we see an almost unbroken trend of increased mobility and increased oil production. And that period is referred to as the Great Moderation. From 2005 to early 2008, the red line, that's when the oil supply stalls out. We see increasing mobility, but no more increases in consumption. And then we see the Great Recession, which is the light green line, where we see both drops in mobility and drops in oil consumption. We then see the little red squiggle, which is the Arab Spring, so that's the 4th oil shock by this count. And then after that, the question is, what happens? If we believe that efficiency can easily offset declining oil consumption, then we should get this light blue line down here that says 2015 full efficiency adjustment. In that case, we'll be declining at 1.5% per year and increasing mobility by historical averages, okay? In such a case, we can say we've made a full adjustment and we can reduce oil consumption without hurting the economy. Where we are more likely is the dotted line coming down here, the 2015 outlook, which is a little bit of an improvement. We're having some significant improvement in new car mileage for efficiency. But in fact, if we look at where we've been in the last few months, mobility has not changed. This country has not been able to regain mobility. It's still beyond the highs of, I don't know, 60 months now or something, since our previous peak for mobility. So efficiency to date has not been able to offset the loss of oil. Okay, so there is a plausible transmission mechanism through mobility into the economy. We can tell you what that looks like. 1 in 6 cars are missing from the road compared to what we would expect a trend, and 1 in 3 airline departures. It's very interesting to see the airline industry. The way they have compensated has been almost exclusively through conservation and not efficiency. So they've reduced the number of small aircraft, increased the number of big aircraft. Doesn't make that big aircraft more efficient, but a smaller aircraft is going to use more fuel per passenger for a given length, okay? And Southwest Airlines, which wasn't until my last flight, my home airline, they've put in an extra row of seats, okay? And that, again, is not efficiency, that's conservation, because you're taking something away to give that back, okay? So in essence today, the theoretical frontier that we're dealing with, in my opinion, is we're looking at how much can efficiency do? Because if we're going to have to reduce oil consumption at a trend of 1.5% per year, then the question is, can we compensate for that with efficiency, and how much? We don't really know that well. All right. So going on. Quickly on gas. Art knows a lot more about gas than I do, but since I'm the last person here, to heck with him. All right. There are a lot of gas plays. Obviously, they're quite prolific. You know, best I can tell, the full cycle cost in the Haynesville, which some people consider the throttle of the industry, it's dry gas, is right around $8 for full cycle cost, $5.50 for marginal cost. So, you know, my assumption, and probably Art knows this much better than me, but we're going back to $5.50 and probably to $8 over some period of time here. Oh, and $8 is also probably around your LNG value. So if we don't, market forces will put you back at a minimum to where exports go, right? At some point, or the marginal cost of production. If we look back historically to 1945, natural gas was a junk fuel compared to oil. Back in '49, the parity value was almost 8 times. So a BTU of natural gas was considered 1/8 as valuable as a BTU of oil. And then it declined as we learned to use natural gas. I think for me, the most interesting thing from this chart here was if you look at the oil shocks, there's a little one in '57, the dotted circle in '73 and '79. What I would point out to you is that natural gas revalued against oil in every case. In every case. Natural gas was the winner to the oil shocks, not oil. Very interesting. Why? Because of substitution. When something becomes more expensive, you learn how to use something that's cheaper. That's not rocket science, and we did. In fact, we effectively got oil and gas to parity by the late 90s. Okay, now of course we have this huge oil to gas price ratio again, a huge BTU arbitrage opportunity which we've not been able to capitalize on, at least not in this country, not so far. But history tells us this is unlikely to last. Here are the economics. If I could fill up my car with CNG, I'd be so much happier. If you take a look at it, these are the economics. You can basically get, last I checked, you can get CNG for $2 per gallon gas equivalent in most of the country. It's fairly stable, doesn't vary that much with the wholesale cost of gas. If you did that and you took our price forecast out to 2018, what you would find is compared to filling up on gasoline, the customer would save $50 a fill up, and the station would have $20 a fill up profit on a single tank of gas. Now to give you, right now a station is happy if they make like 7 cents on a gallon. So if you did 17 cents, it's maybe $1. So this is like 20 times more profitable than gasoline. If you had stations selling as much CNG as premium gasoline, so about 10% of their total volume, CNG, including the convenience store, CNG would represent 60% of their profits if they just sold 10% of it. Okay. So there's a huge arbitrage opportunity right now on paper to go and find other types of transportation fuels. This would imply natural gas cost around $16, $18 in the post-2020 period. And our anticipation is that we will see material switching by late in this decade. Finally, on the global scene here, obviously there's a lot of shale gas in lots of places. This is not the one where Argentina struck out. I was born in Argentina, so there's no one I like dissing more than the Argentines. They have some there, they also have some oil. China's really critically important. I mean, in any forecast you look at, we do a lot of conferences on LNG and FLNG. And you know, how China does with its CBM and its shale gas is just incredibly important in the whole LNG export market globally. Just to give you some orders of magnitude, China, last I checked, consumes about 4 BCF per day, per capita 1/25th that of the United States. They will increase their consumption by about 10 BCF per day. In 2011, we increased our shale gas production by 5 BCF per day. So that, in essence, 2 good years of shale gas increases in the US could see China through to 2020. Okay, just to give you a feel for sizes. So if the Chinese can do something with it, it's going to change the dynamics there quite a bit. Obviously, it's out in the West. They have water issues, infrastructure issues. You know, we'll see how that plays, but just to give you a feel for it. CNG, see this is, it's amazing what you can find on the internet if you go look. All right, so some conclusions about markets. The global economy is supply constrained for oil. Adjustments must therefore mostly occur on the demand side, particularly in the OECD economies. Okay. US adjustment is now elastic. My view is this is a sort of a developing theoretical notion is that you toggle between elastic and inelastic behavior. If you're pessimistic, then you're elastic. If you're optimistic, you're inelastic. Fear and greed, animal spirits, if you like. Okay. China will probably be breaking in elasticity now. When you're elastic, what happens is if the price goes up, you don't reduce consumption. Okay, you struggle to hold in there because you're optimistic that your wages will go up, or you'll be able to offset it some other way, or that the price shock is transient. Okay, so then you say, oh well, I've got to pay another $1 more for gas. Okay, well I'll borrow some money to do that, or I'll do it and hope that my income increases. In that case, what you're going to see, if there's a demand shock, that most of that will translate into price. Okay. If demand is elastic, so if nobody has any credit left, where's Gail? If nobody has any credit left, and people are pessimistic about the future, and they think a price shock is permanent, or price change is permanent, then they will adjust pretty quickly. They won't fight for it. And in fact, that's what we see in the US now. A very depressed population, very little hope in the future, and a willingness to cede consumption readily. So we don't see this kind of price spiky type behavior because the consumers will let off quickly. They're just not optimistic, okay? But that pessimism is incredibly important to adjustment. It's very important. It's what allows us to go forward. When you move in back home with mom and dad, right, you're becoming a realist compared to the energy budget that you have that day. That's the situation, right? Because if you hold on to your apartment and you take out some more debt, and you say, well, it'll get better, right? Then you're not adjusting. You're still optimistic. But if you're pessimistic, then you're accommodating your environment, and that's very important. China's a very large country. Okay. We find if we do these analysis, oil market should find fundamental support around 105. There's been quite a lot of discussion of oil prices collapsing lately. Paul Sankey was out with this. Goldman Sachs had a very depressing report. And of course, my friend Ed Morse at Citibank has never found an oil supply he couldn't make bigger. But we think it's going to be around there. You can have a recession in all this, but if you have China's latent demand always lurking out there, okay, what happens if price falls, then it doesn't stay there. What happens is then our belief is that economic activity expands because oil is constraining economic activity. Therefore, if you have more oil, economic activity expands and the price will come back into this carrying capacity type range. That's our model, and I think that's probably right because it's here, so it has to be. All right. This suggests also that oil prices increase about 7% from here on out. We're aligned with the IMF on this view, different methodology, but similar conclusion. Natural gas has passed the low point, and it'll increase in price, we think, in the next several years. And as a transportation fuel, it will be quite valuable. Here's some policy things just to spike the next series. So peak oil isn't over, at least for the advanced economies. You know, my friend Steve Levine, who is a foreign policy now at Quartz, he keeps writing these cornucopia things, and I keep looking for him, and it's Iraq and the US and Canada. And so like, okay, we know Iraq and the US and Canada, but that's all he's got. But for him, it's like, ooh, the abundance. I don't know where it comes from. Anyway. Carrying capacity is limited. That's going to mean limited upstream spend growth. I have to tell you right now, there are some signs that the oil business is beginning to cycle. You know, that this thing is, we're going through what could be a CapEx cycle, and I'm not sure what's going on because I depend on everybody being optimistic and giving me money to do market research. But that's a very scary thing to cycle without really a material economic boom. So carrying capacity issues, how are these companies going to get their heads around the fact that their CapEx budgets aren't going to be growing like they used to? Because that's the kind of reality that we're beginning to see now. And this is very important for not only IOCs, but my clients like FMC and Cameron and Baker Hughes and those guys. Because that upstream CapEx spend is their revenues, right? So what Shale spends on subsea trees is revenues for Aker Solutions or Cameron or GE Oil and Gas, right? And finally, China is still a large country. We have to talk, you know, we need to start dealing with these emerging economies with a certain amount of respect. These are big countries, and they will develop, and they're going to show up at the table. I mean, Shale again will talk about, oh, we're addicted to oil. Yeah, but the truth of the matter is we got addicted to oil at a time when China was literally invisible to us. Okay, had China not been a communist country, had it developed like South Korea, right, we would have had this adjustment in the 1980s and 90s, essentially when that great moderation was, and our consumption should already be adjusted to having 2 or 3 billion other people also making a call on that oil supply. So we shouldn't think of China as doing some sort of strange or kind of weird thing. They're just becoming a normal country, and this is just the pressures because they're big. If it were Liechtenstein, we wouldn't care, but you know, China's a big country. Climate policy. We do have a climate policy, sort of. Oil consumption is down 9% from the peak, coal consumption down about 15%, and we are pretty much on track for Kyoto, which we didn't sign, interestingly enough. Maybe a little bit late, but pretty close. Well, don't clap yet, because that's not all good news. But oil production is up. So the question is that some of the climate people are beginning to feel now is, wait a minute, because if they say, oh, but climate, I'll say, okay, but we're declining oil consumption at 1.5% per year. Well, how fast do you want to decline it? You know, I mean, do you just want to flat out destroy the economy, or? And like, well, but. So then the question is, okay, but oil production continues to increase, right? So wait a minute, so the US and Europe are decreasing, oil production in aggregate is increasing, so what's the policy response, right? Because you can't blame the US, we're already reducing it. So you're gonna have two, one is to see if they can affect China, which they can't. So the question is, are they going to look to reduce the supply from the OECD? And if we talk about no Keystone XL, new fracking permits, or who knows what happens in Alaska, what we are talking about is attempting to strand North American resources. Okay? So the question is, where do we go there? So we have a kind of climate policy, it's sort of backwards, but I mean, you need to understand this climate policy is involved with 5 million people not having work. Okay, there's a trade-off, one-for-one trade, well, it's not one-for-one, but it's pretty close, one-for-one trade-off between climate and GDP. So this is not, you know, win-win. This is a win-lose scenario that we're looking at here. Economic policy. There is to date no real acknowledgement anywhere of the link of oil to GDP. Not at the CBO, nowhere. And the question is there a linkage? Can you actually increase oil consumption efficiency by 4.5% every year to the horizon? We don't know. And there's little priority to economically viable transportation fuels. So we're very happy to talk electric cars, which are not economically viable. We're doing a project for DOE on offshore wind, which is lovely, super expensive. But there's not, you know, if you believe that GDP is being constrained by the oil supply, you better get on your bike and start pedaling, because this is a serious issue and it's not going away. Okay. Finally, it's interesting to see what happens if the US cycles back into recession. Obviously, we have the Obama administration now back in power with something of a mandate, I would say. You know, I mean, the direction definitely went in kind of that greeny type direction. On the other hand, let's see what happens if the US cycles back into recession. ECRI on Thursday, the Lakshman Achuthan of the Economic Cycle Research Institute reiterated his call for a US recession. He pegged it to have begun in July of 2012. There was a nice little chart that the Fed uses that was showing that when it got to this level, it went straight to recession. My friend Jim Hamilton and a couple of other guys immediately debunked it, but maybe it doesn't stop. So it's interesting to contemplate what happens here if the US does in fact cycle back into recession at a time when we're running $1 trillion deficit and have quantitative easing out the wazoo. That's the technical phrase, wazoo. You know, what sort of world do you inhabit in that time? If you're in peak oil, that's not such a strange world at all. If you're a Keynesian economist, you don't know where the hell you are. So, thanks very much. That's all I have, and then I welcome any questions in whatever format Jan welcome to take.